Many companies calculate profits correctly for accounting purposes but get it wrong for tax purposes. For years, there has been a gap between what your books say and what the taxman expects. Under the new Nigeria Tax Act, 2025, that gap is closing. Accounting profit is no longer enough. The law now clearly defines how total profits must be computed for tax, and the rules have changed significantly. Welcome to A Stitch in Tax Saves Cash, the show where we interpret Nigeria's tax laws in a practical, compliance-focused way that helps your business reduce risk and legally save cash. My name is Olatunji Abdulrazak, founder and CEO of TaxMobile Online, a professional tax knowledge platform supporting taxpayers, tax professionals, and tax administrators across Nigeria and Africa. In today's episode, we are breaking down a critical piece of the new legislation, Section 27 of the Nigeria Tax Act, 2025. This section governs the computation of total profits for companies. Getting this right is not just important, it's fundamental. So, why does Section 27 matter so much? Think of it as the foundation of your entire company income tax return. This single section determines what constitutes your total profits, how you can claim capital allowances on your assets, how you can relieve business losses, and even how transactions involving digital assets are taxed. Errors here have a domino effect. If you misunderstand Section 27, every other tax computation you do will likely be wrong. This can lead to serious consequences: overtaxation where you pay more than you should, disallowed capital allowances where you lose out on valuable reliefs, disputes with the tax authorities over how you've used your losses, and ultimately increased audit exposure. It is the master key to corporate tax compliance. So let's dive into the core rule. What exactly is total profit under the new Act? Section 27, subsection 1, gives us a single, consolidated formula that simplifies the entire process. It states that total profits equals your assessable profits from all sources, plus any chargeable gains, minus your allowable losses, and finally, minus your capital allowances. This is a big deal. This provision collapses all your different taxable income streams, whether from trading, investments, or asset sales, into one single tax base. However, it still recognizes the statutory reliefs you're entitled to. Like losses and capital allowances, the goal is clarity and consolidation, making the starting point of your tax computation unambiguous. Now, let's talk about one of the most significant reliefs for businesses: capital allowances. These are the tax-deductible portions of your capital expenditure on assets like machinery, vehicles, and buildings. Section 27 introduces some strict new eligibility rules. First, under subsection 2, to claim capital allowance, the asset must be used to generate assessable profits. That's standard. But here's the game changer: capital allowance will now be denied if you failed to pay the proper taxes at the point of acquiring the asset. Specifically, if value-added tax, or VAT, was not charged where it was applicable, or if the correct import duties and levies were not paid on an imported asset, you forfeit your right to claim capital allowance on that asset. This means capital allowance is now directly tied to your broader tax compliance. The message is clear: comply from day one, or lose your reliefs later. What about assets that are not used 100% for the business? Section 27, subsection 3, addresses this with the partial use rule. Where an asset is partly used for business and partly for private or non-business purposes, the capital allowance must be prorated. For example, if your company owns a vehicle that is used 70% for business activities and 30% for the managing director's private errands, you can only claim 70% of the calculated capital allowance for that vehicle. You need to keep records to justify this apportionment. However, the law also provides some administrative relief. Under subsection 4, there's a de minimis rule. This means that if the non-taxable use of an asset is insignificant, let's say less than 10%, you don't need to go through the trouble of prorating. You can claim the full allowance. This is a practical provision designed to reduce unnecessary administrative burdens for minor non-business use. Next, the Act introduces a major shift for companies operating in priority sectors or enjoying specific tax incentives. Section 27, subsection 5, brings in a strict ring-fencing rule for these incentive-based businesses. This is designed to ensure that tax incentives are used for their intended purpose. Here are the key rules. First, any capital allowances tied to a priority activity can only be deducted against profits from that same activity. You can no longer use generous allowances from a pioneer business to shelter profits from a mature, regular business. Second, losses from that priority business cannot be offset against profits from your other and related trades. The losses are locked within that specific business line. They must be utilized as soon as possible against future profits from that same activity. Furthermore, these losses must be computed in line with sections 22 to 25 of the Act, ensuring consistency. In short, government incentives are now highly targeted. They are not a blank check to wipe out all your company's profits across the board. Now for one of the most forward-looking provisions in the entire Act, which appears in Section 27, subsection 6. This rule addresses the tax treatment of digital assets. For the first time, Nigerian tax law provides clear guidance on how to handle losses from cryptocurrencies, virtual assets, and other digital transactions. The rule is simple but powerful. Any losses rising from these activities can only be offset against profits from similar digital activities. Let me give you an illustration. Imagine a company makes 50 million naira in profit from its core business of trading goods. In the same year, it loses 10 million naira from its cryptocurrency investments. Under this new rule, that 10 million naira crypto loss cannot be used to reduce the 50 million naira trading profit. The loss is ring-fenced. So what happens to that loss? It's not gone forever. It can be carried forward indefinitely, but it can only be applied against future profits from digital asset transactions. This provision is designed to protect the general tax base from the high volatility often seen in the digital economy, ensuring that losses from speculative activities don't erode tax revenue from stable, traditional business operations. So, with all these new rules, what are the practical implications for your business? First and foremost, compliance and record keeping are more important than ever. You must maintain detailed capital expenditure schedules. You must keep evidence of VAT and import duty payments for every asset you acquire. You need to maintain asset usage logs to justify any apportionment for partial use. And critically, you need to keep separate financial records for your priority businesses and your digital asset activities. Without these records, you cannot defend your tax position during an audit. Second, this calls for proactive tax planning. Good tax planning now begins at the transaction design stage, not at the end of the financial year. Before you even buy an asset, ensure your supplier is VAT compliant and that all customs duties will be paid. If you are venturing into digital assets, consider setting up a separate subsidiary to structurally ring-fence those operations. And finally, don't defer the utilization of your losses unnecessarily, especially ring-fenced ones, as their use is now restricted. Let's recap the key takeaways from Section 27. First, total profits now follow a strict statutory formula, moving away from reliance on accounting profit. Second, your eligibility for capital allowances is now conditional on your compliance with other taxes like VAT and customs duties. Third, assets used partially for business must have their allowances prorated. Fourth, incentives are now ring-fenced to the specific activities they are meant to support. And fifth, losses from digital assets are also ring-fenced and cannot be used to shelter general business income. From a professional standpoint, the message of Section 27 is clear. It's about discipline, clarity, and revenue protection. As a business owner or finance professional, you must learn to separate accounting profit from taxable profit in your mind. You need to understand the complex interaction between capital allowances, loss relief, and incentives. And you must start treating digital assets as a distinct tax stream with its own set of rules. If this episode has clarified how total profits must be computed under the Nigeria Tax Act 2025, then it has done its job. The new regime demands a higher level of precision, and being prepared is your best strategy. Please like this video, subscribe to A Stitch in Tax, Saves Cash, and share it with a CFO, finance manager, or tax professional who is preparing for the 2026 tax regime. Knowledge is the best tool for compliance. I am Olatunji Abdulrazak, founder and CEO of TaxMobile.online, and I will see you in the next episode.